In this module, I will give you a selection of trading tips, arranged into sections that correspond to the 5 steps of 5-step trading, so you know where they have the most relevance. Of course, when people hear the words trading tips, they like to hear which stocks to buy and which to sell. Unfortunately, that's not going to happen in this module. The reason is not because I don't know which stocks I like to buy or sell, it's because I want you to learn yourself which stocks to buy and sell. In the end, it's your own money and your own responsibility to invest and trade wisely. Listening to other people is normally a mistake, so what I would like to do here is to fill up your toolbox with thoughts and methods and as much knowledge as possible, so that you have a better chance of making money on your own. That is what I mean with trading tips. This is what legendary stock trader Jesse Livermore had to say about trading tips. The average man desires to be told specifically which particular stock to buy or sell. He wants to get something for nothing. He doesn't wish to work. He doesn't even wish to think. He made this statement 100 years ago, and it's still valid today. Hopefully this module will help you to do better than the average man he was referring to. Some of the material in this module I have touched upon before, but feel the need to elaborate upon. Other parts are new and important as well. Let's start with trading tips that you might find useful when trying to find good ideas.
Trading tip 1. You have to be in it to win it.
I often hear from people that they've had an amazing trading idea, but when I ask them how much money they actually made, they often say 0, because they didn't trade at all. You may be the master of original trading ideas, but you have to be in it to win it. 5-step trading hopefully stops you making silly investment decisions at steps 2 through 5. So moving a good idea to step 2 for further analysis is not the riskiest thing in the world. Don't be afraid to analyze further if you have a promising idea.
Trading tip 2. Take advantage of your size.
There is one major advantage of being a small investor versus a large investor, and that is that you don't need to trade all the time. Fund managers manage large sums of money for clients who want their money invested, not held in cash. This forces the fund managers to put the capital to work in the stock market, even when they don't have strong opinions. You, on the other hand, can keep your powder dry, with no outside pressure on you to invest your money right at this moment. There is no rush to trade, and there will always be an endless pipeline of opportunities. So wait until the odds are in your favor and only invest when you see a real opportunity and have done your 5-step trading analysis.
Trading tip 3. Boring stocks can make you a lot of money.
It's easy to focus on exciting, volatile industries for your trading ideas, but some real money can be made in supposedly boring, stable industries.
Here is the chart of BAT Tobacco. Look at the phenomenal stock price performance. Also, notice how little volatility this stock has experienced. This company has amazing management, which runs its business very efficiently. They moved into emerging markets when the rest of the world was still asleep, and the fact that they sell a very addictive product has not hurt them either. Or McDonald's, another stock with great management and a great emerging market strategy. So never write off a stock because it's not in an exciting sector. When a stock like this makes money, you will see how exciting it really is.
We're not saying that this is a good stock to buy going forward, as we have no idea when you will watch this module. But it does show that a stock like this can make you a lot of money.
Trading tip 4. Decide the time frame for your investment.
When you have a trading idea, you need to consider what time frame it applies to. You might believe that Apple iPad sales will be great next week. However, you might also believe that over the next few years, Samsung will come up with better and cheaper products. This means that short term, you may want to buy Apple, but longer term, you might want to short it. So there you have 2 directionally opposing trading ideas in the same stock, but with 2 different time frames. And that is totally fine. Instead of one trade, you potentially have 2 different trades in the same stock.
Alternatively, ExxonMobil on the longer term chart looks to be in an uptrend and you might decide to buy dips. But short term, you might have a good reason to go short this stock as well. Trading tip 5. Additional inspiration for idea generation, peer group.
In 5-step trading, we talked about 2 ways of generating ideas, either bottom up or top down. Also, what not to do when generating ideas. For example, listening to rumours. However, there are many other ways to generate ideas that people out there use, and I would like to discuss them here. They each have their own specific risks, but they might help you find new ideas. As always, make sure you go through the other 4 steps before you actually put on a trade. The first alternative way to generate trading ideas is by looking at the price action of a group of stocks in a specific sector, and then drawing conclusions for the whole sector. If Exxon and British Petroleum go up, but Royal Dutch does not, then it might be a good idea to buy some Royal Dutch. Or if Bank of America has gone up, then maybe it's time to buy some Citigroup. There may be good reasons why some stocks have been left behind or have outperformed their peers. But working through the 5-step trading process should help you establish whether you have identified a valid trading opportunity. However, make sure you don't end up pair trading within a sector, as we discussed in the Trading Mistakes module.
Trading tip 6, additional inspiration for idea generation, my trading screen.
Another way in which I generate many ideas is by just looking at the trading screens in front of me, which are configured to allow me to follow a wide range of indicators, assets and securities. To get trading ideas from your trading screens takes time and experience. You need to spend time looking at how markets trade and how they move versus each other. For example, if credit markets are improving and it is easier to get a bank loan, equity markets tend to do better as well, because it is cheaper and easier to get access to capital. Now, if you see that credit markets are deteriorating, but equity markets are not dropping, then this might mean it is time to sell equities. This of course is not foolproof, but something to watch to get inspiration for new ideas. Or, if copper starts falling, you may decide to sell a mining related name. Or, if oil goes up, maybe this will be negative for the economy and thus for stocks, and you may want to wait a little before you buy any stocks at all. A good trading screen will generate many ideas and really keep you in touch with the markets. I will discuss the indicators I look at in much more detail in the special trading screen module.
Trading tip 7, additional inspiration for idea generation, supply and demand.
A third alternative way to generate ideas is based on supply and demand of a certain stock. This is a more dangerous area to investigate, as it is often consensus based. The aim is to find a security where there is more demand than supply. This happened a lot during the internet boom years, when many stocks increased tenfold because the quantity of stock available in the market was much smaller than the demand. An enormous amount of money tried to get involved in a very small part of the market. What makes this so dangerous for traders is that when that inflow of money reverses, the stocks totally collapse and a lot of people lose their shirts. This situation often occurs in emerging markets when there is an influx of foreign capital. The money enters these countries at great speed, but leaves as quickly as it came in. Think of countries such as Indonesia, Vietnam, but also Russia and even Japan. To reiterate, while I don't think this is for beginners, a lot of people trade based on it, so it is important to be aware of it.
Trading tip 8, additional inspiration for idea generation, catalysts and events.
The last approach that you can use to generate ideas is to find events or catalysts that might cause a large move in a stock or the whole stock market. A catalyst or event for the general market can be important economic data, such as the ISM report or monthly employment data. For a company, it can be the launch of a new product, or an earnings announcement, or maybe the outcome of a legal dispute. The calendar of these catalysts is often known, and the outcome binary. A profit warning or not a profit warning on the day of results. A win or a loss of a lawsuit. Approval or failure of a new drug. So if it is known that there is an event approaching, and if you happen to have a view on the outcome of that event, then you can develop a trading strategy around it. Returning to the example of Apple, the launch of a new iPad is a catalyst event. And if you believe that people will be impressed at the launch and optimistic about future sales, then you might well buy the stock beforehand. However, if you were waiting for a catalyst and the event has now happened, it might be time to let go of the stock and sell it, and focus on finding a new trading opportunity. As with the previous trading tip though, catalyst trading is not necessarily a recommended strategy for beginners. Let's now continue with some tips that will improve your fundamental analysis once you have found a good investment idea.
Trading tip 1. More information is not the same as better information.
I had a colleague sitting next to me when I worked at Goldman Sachs who was very clever. He was able to find interesting areas to look at and came up with original trading ideas. However, he always found another research report to read about that company. By the time he was ready to trade, the market had already moved and the opportunity was gone. In this day and age, there will always be more data to analyze. However, there is a limit to what you can realistically achieve. Also, academic research shows that having more data does not necessarily lead to better investment decisions. I recommend you take a pragmatic approach. Of course, make sure you do plenty of research before you trade, but know your limits and only do what is reasonably required to gain sufficient comfort about an investment opportunity.
Trading tip 2. Use modern technology.
There are so many internet sites that have all the information you need about stocks. This information is created real time by tens of thousands of users, and no newspaper can keep up with that kind of speed. Of course, you shouldn't listen to gossip and malicious rumors, but these sites can still be useful for giving an idea of what other people are thinking about a stock at a certain moment, potentially saving you a lot of time when doing your research. I especially like the social media ones, and you can follow me on Twitter @LexsVanDam.
Trading tip 3. Price earnings work well for stable companies, but not for all companies.
In 5-step trading, we focus mainly on price earnings ratios to compare companies. This works well for mature, stable businesses, such as tobacco companies or food retailers, or other companies where the earnings are positive and there isn't too much debt. Unfortunately, if the earnings are negative or the company has a lot of debt, the PE ratio becomes meaningless. For example, if you have a company that is investing heavily in new factories and marketing and increasing market share, the earnings might well currently be 0, and thus the PE will be very high and will not be helpful when deciding whether or not to buy a stock. Or if you analyse a property company with lots of assets, but with no earnings, the PE does not help you either. In addition, using the PE ratio to compare similar companies does not work if one of the companies has a lot of debt and the other has very little or no debt. This is because the company with a lot of debt has to make interest payments to the debt holders, while the other company can pay it straight to the equity holders. So the earnings will not be comparable and neither will the PE ratio.
Here you see the PEs of US telecom giants AT&T and Verizon. They've been pretty comparable over the last few years. No surprise, really.
There are several other methods of valuation that we can use instead of or in conjunction with the PE ratio to help paint a more transparent and accurate picture of what a company is worth. If you want to look into this, then the Knowledge Bank on the website has a lot more information.
Trading tip 4. It's hard for a stock to do well if the overall market does badly. Historical data shows that a stock's return is determined for 50% by the market, for 25% by the sector it's in, and for only 25% by the characteristics of the stock itself.
What this means is that even if you have found a great stock to buy, if the market drops, then there is a high probability that your stock will drop too. If your stock is part of a sector that is going out of favour, your stock is more likely to perform badly. So if you want to buy a high-quality bank share, but increased regulation is making the bank sector less profitable, then this might make your idea more risky. In 5-step trading, you're forced to really understand the company that you invest in, which hopefully has the added benefit of giving you the confidence to hold on to a position when the price moves against you. But at the end of the day, you own a stock, and if the market goes down, you might have to cut your position independent of the individual fundamentals of the stock you hold. That's why it's important to always consider the sector a stock is in and overall market direction as well.
Trading tip 5. Respect money, invest in knowledge.
I refer to the use of PE ratios as a way to assess whether a company is cheap, but highlighted that it does not work for all companies all the time. I also said that if you look at the knowledge bank, there are more valuation methods that might be helpful for you. Here I want to emphasize the importance of hard work again, even when the material is challenging and not easy to master. All successful traders work very hard, even though they might sometimes give you the false impression that they spend more time on the beach than behind their trading screens. You also have to realize that learning never stops, because markets always change, and that it is essential to have an inquisitive mind if you want to be successful in the markets. The more you invest in knowledge, the more you invest in your own financial future. So even if you don't understand it all immediately, it's still worth investigating. You will often pick up something that could prove useful at some stage in the future.
Trading tip 6. Find the credit rating of the company.
Rating agencies judge a company's financial strength based on its ability to pay off the loans that it has outstanding. Knowing the credit ratings of the companies in your portfolio gives you a good idea of the financial quality of the companies that you actually own and the risk in your portfolio. The highest rating is AAA for the strongest companies, and the lowest is D, when a company can no longer pay its debt and is bankrupt. You can find the ratings as always on the internet, but make sure that you look at the most recent rating and not at an old one, as credit ratings do change over time. Ratings above BBB- on the S&P rating scale are known as investment grade. If a ratings agency downgrades a company to below investment grade, this will mean that a lot of managers can no longer own the stock of this company, and the stock could sell off significantly. Let's now focus on some tips in the area of reading and using charts.
Trading tip 1. Ultimate decision in trading is range versus trend.
People can spend a lot of time analyzing charts, but at the end of the day, the main decision that drives any technical strategy is whether we are in a ranging or a trending market. If you are ranging, you should buy the lower end of the range and sell the higher end. If you are trending up, you are unlikely to buy at the previous low, because that price will probably not be seen again, and you should aim to buy the dips. In a downtrend, you should not buy the previous low, as the stock market most likely will keep going lower. Of course, with perfect hindsight, it is easy to know if a stock is ranging or trending. However, it is a lot harder to predict what will happen in the future. As a rule of thumb, I would say that history will repeat itself, unless the fundamentals of the company change or the general market direction forces the stock chart to change character. In any case, reading and predicting charts will always remain more of an art than a science.
Trading tip 2. Stocks range more than you think.
I previously mentioned that I believe that stocks range a lot more than people assume. The idea here is that you should take advantage of that and trade the range. Here once again you see the chart of the S&P 500 over the last 12 years. It shows that in markets like the ones we have seen over that period, you're much better off trading the range. So when stocks get oversold and everybody is depressed, it is time to buy. And when everybody is euphoric, you should let go of your stocks and maybe even go short. Buy and hold has definitely been a mistake over the past 12 years. Perhaps it can work over 50 years, but I don't have the patience and cannot afford to realize after those 50 years that it was indeed wrong to hold stocks. So that strategy doesn't work for me. I would rather trade my portfolio of stocks, not necessarily on a very frequent basis, but I believe that at the absolute minimum, at least once every 6 months, everybody should have a very critical look at their stock portfolio and see if their positions are still suitable. Of course, this doesn't mean that you should sell all your winners. It just means that you need to carefully monitor your best performing stocks as well, to ensure that you don't give up all your profits if and when the stock starts trading down.
Trading tip 3. Look at relative charts.
It's important that you not only look at absolute charts of stock, but also at relative charts. That is because some very big investors in stocks often do exactly that. Here we're referring to pension funds and insurance companies, which are amongst the biggest players in the stock market. They look at stocks and sectors on a relative basis to the market. For them, these relative charts of a stock or sector versus the overall market are very important because they show long-term trends in the market. Especially breaks of multi-year trend lines are key to these players. That is why it's important for you as well to not only look at absolute charts of stocks, but also at relative charts versus the general market.
Here you can see the charts of the utility sector in the US, which has done very little all year. And here you can see it versus the S&P 500. And suddenly you can really see how you would have underperformed the general market by owning these defensive stocks. When the utility sector breaks out versus the S&P index, this could well mean a lot of money will be put to work in this sector, which might mean a trading opportunity for you. Trading tip 4. Consider multiple historic timeframes.
When you analyse a chart, it's good practice to look at more than one time period. Longer-term charts give you a historical perspective, especially for those periods with extreme price movements. On the other end of the spectrum, short-term intraday charts will help you understand exactly how a stock is trading right now. A short-term chart like that can really help you obtain the best possible trade execution price from your broker. Over time, that will save you real money.
Trading tip 5. Don't wait for the chart to show you that you were right all along.
In 5-step trading, we don't use charts to confirm that our view is right before we trade. We use them to buy or sell at the right time. We aim to focus on non-consensus ideas, where we can get a good entry price. We are also wary of buying and selling stocks that have recently rallied or fallen significantly. That is because a lot of other investors may already be ahead of us, and the trade might already have run its course before we even get in ourselves. In practice, that means we should aim to buy a stock at the lower end of the range, as opposed to waiting for the stock to go up a lot and the chart to look really bullish before pulling the trigger. In the case of Glaxo Wellcome, it would have meant having the confidence to buy the stock at the equivalent of about $32. It's very common for people to not buy a stock until it has gone up a lot. And if you had done that here, you would have made very little money, if any at all. For our purposes, it's wrong to buy stocks at the upper end of the range, unless there is a fundamental change taking place.
Trading tip 6. Use charts to make sure you trade the right trading instrument.
It's surprisingly easy to lose money, even when you have the right view. Often this is because people trade the wrong instrument. Let's say you have the view that the price of gold is going up. It's easy then to say that this is good for gold stocks, and so you end up buying a gold stock. Here you see the chart of a few gold stocks and gold itself. This is a chart of gold itself. This is a chart of Yamana Gold, a large cap listed in the States that is a large gold producer throughout Brazil and Argentina. And this is Semafo, a Burkina Faso-based gold miner listed in Canada. The stock started falling when soldiers started shooting in the streets. What is clear is that these stocks and most other gold miners have significantly underperformed gold itself. And also that they have been very volatile with enormous drawdowns, which could easily have led you to exit the position prematurely and wrongly. There are many reasons why gold itself has been a far superior investment than investing in gold stocks. The actual mines can be in dangerous areas. They might have a labor force that wants to be paid more. They might have hedged their output, or the management might be incompetent. Also, the flow of money into gold for safety reasons tends to buy physical gold and not gold mining companies. So if you think gold's going up, you either buy physical gold or you buy an instrument that trades similar to the gold price. Looking at the chart should make it clear whether the gold proxy you picked follows the price of gold or not, as we will see in the next tip.
Trading tip 7. Use charts to help you avoid the wrong ETF.
As you know, an ETF is an exchange-traded fund that makes it far easier for investors to trade financial instruments or themes. One popular ETF tracks gold and has ticker symbol GLD. When you chart GLD, you can see it closely tracks the gold price. So that's a relatively efficient ETF. But if you look at the price of crude oil, then you see that the ETF that tracks it, which is called the USO, is considerably underperforming the price of crude. So as far as I am concerned, this is a very dangerous ETF to buy. The reason for this is that the USO is backed by crude oil futures. These futures need to be rolled frequently, and there can be a serious cost attached to this. Another trade you might consider is to be long volatility as a hedge to your portfolio. The idea is that if the market drops quickly, you will probably lose money on your stocks, but you will make money on your volatility trade, because the volatility of the market tends to go up when the market falls. Here's the chart of the volatility ETF VXX versus the real volatility index VIX. We discussed the VIX in the original 5-step trading modules. You can see that just as with crude oil, it doesn't track it over long periods. So my advice is to only use these instruments for very short-term purposes, and always compare ETFs to the instrument they are supposed to track to see how efficient they are. If you ignore this tip, you can lose a fortune, as many others before you have done. Now let's look at some tips concerning trading psychology.
Trading tip 1. Establish whether you are a bull, a bear or a pig.
The Chinese say that it is easier to move a mountain than to change someone's personality. And I think that's spot on. Some people have an optimistic nature, and when they analyze a company, they take a positive approach when interpreting the data. They are known as bulls. Other people are more negative and don't trust a lot of things and always expect the worst. When they look at the same company as the optimists, they see the dangers rather than the opportunities. These are the bears. The saying goes that bulls make money, bears make money, but pigs get slaughtered. It means that it's okay to have a bullish tendency and it's okay to have a bearish tendency. But when you are a pig and your approach is inconsistent, you will probably be bullish at the top and bearish at the bottom, and you will end up losing a lot of money.
Trading tip 2. As soon as you tell your friends how good you are, you will start losing money.
Whenever people make money, they tend to feel relaxed, happy and upbeat. And when they make a lot of money, they often start to tell other people how the market really functions. You might think you are different, but only few people are able to keep these things to themselves somehow. Anyway, be aware that when you start telling other people what to do, then in my experience, this is exactly the phase where you will be about to lose a lot of money yourself. So my tip is, when you make a lot of money, don't tell other people what to do. And when you can't resist doing this anyway, it is time to take off all your trades as you are about to lose a lot of money.
Trading tip 3. Accept that trading is psychologically an asymmetric occupation.
When I make money, I'm happy. When I lose, I'm depressed. However, I never seem to feel as happy when I make $100 as I feel depressed when I lose $100. That is what I mean when I say trading is asymmetric. When you make money, you say to yourself, of course I'm making money. I did the work and I was right, and it is pretty satisfying. But when you lose money, after spending so much mental and intellectual energy, it is seriously upsetting. I guess it is part of human nature, and the only thing we can do is accept that this is part of the life of a trader, and that it will help keep losses down. I would rather be like this though, if it helps me avoid losing money.
Trading tip 4. Great traders never blame anyone else.
The easiest thing to do when things go wrong is to blame other people, or your trading screens, or your broker, or the government, or some random market dynamics. Accepting that you control your own destiny is the hardest thing to do in trading, yet it's so important. At the end of the day, trading based on the wrong information is your fault, and you should have checked it better. Blaming politicians for erratic price movements makes no sense, as you should have predicted that they would act the way they did. The market always does odd things at exactly the wrong time. They're all facts of the life of a trader. It is up to you to accept them and to accept that you control your own destiny. So never ever play the blame game.
Trading tip 5. We all get what we want from the market.
The guy who was in charge of Lexs' trading desk at Goldman Sachs loved to use the expression, "We all get what we want from the market." It normally takes people a long time before they realise what that means. It means that the market is a mirror and that your trading style is a reflection of your own personality. If you're a person who loves action, you will take a lot of risk and have big profits and big losses. If you are a careful person, you'll probably do a lot of research before you trade, possibly so much that you hardly ever trade and thus not make any money either. But it goes much deeper than that. For example, people who have depressive tendencies might well keep risking everything and making the same mistakes over and over again to punish themselves. Again, you might not realise this when you start out trading, but it is important once every so often to look at yourself in the mirror in a hard and analytical manner to really try and find out why you are involved in the markets.
Trading tip 6. Take advantage of capitulation.
Sometimes there are situations where people are forced sellers of a certain security. For example, Nick Leeson had a very large long position in the Japanese Nikkei in 1995 and bought down the UK's oldest investment bank Barings with it. Nobel laureate hedge fund Long-Term Capital had very large positions in many different relative value trades as well. When the rest of the market got knowledge of their sizable trades, they immediately pushed the market against them. Of course, at a certain moment, Barings and Long-Term Capital could no longer bear the losses and had to cut their positions. Clever traders then bought those positions at prices way below fair value and made an absolute fortune. These are extreme situations, but in general, when sentiment is overwhelmingly negative and people give up on a stock, this could be an amazing buying opportunity.
Trading tip 7. There is no easy money out there.
I went through a period where I listened to a trading advisor who specialized in something called cycle theory. Supposedly, he was able to analyze the cycles in the stock market and predict where the market would go next. He was a great salesman, much more so than being right about calling the market. But somehow I became quite dependent on his views and was looking forward to his daily email to see what I should be doing. However, when the market did not do what he predicted, he would disappear for weeks. On his return, he would always deny having been wrong. From my side, it was obviously really difficult to know what to do. Should I cut or should I hold on to my positions? It became psychologically very difficult, and I decided never to follow anyone else's trading tips again. I would much rather try to invest in building my own knowledge and learn from my own mistakes. When you follow other people, you may not even know why you traded in the first place, and most likely will not know what to do when it all goes wrong. Also, blindly following other people means that you are not developing your own trading skills and are just a gambler with the odds massively stacked against you. So don't pay for expensive trading systems, because 99% of them are frauds. And don't become dependent on any external source. There are no shortcuts here. There is no easy money. Making money requires hard work and a lot of persistence. Now it's time to focus on risk. And as you know, risk control is the most important part of trading.
Trading tip 1. Keep on top of the reasons for your trade.
When people have had a position for a while and I ask them why they own that particular stock, the usual answer is that it seemed a good idea at the time. The longer a position has been held, the less conviction people seem to have in that idea. That is why it's important to keep reminding yourself regularly of the reasons for each trade and why the reasons are still valid. Not quite knowing why you have certain positions in your portfolio dramatically increases the risk of future losses. Of course, keeping a trading diary with dates and reasons of your trades will make this a lot easier. And don't forget to write down the level at which you will cut your position when things go wrong.
Trading tip 2. Keep on top of the statistics.
When you keep that trading diary, as I just mentioned, please don't only log the reasons and dates for your trades, but also your entry prices, as well as your exit levels. Now you have enough information to calculate some important statistics, such as the profit and losses you have made. You can look at the average duration of your trades and the average transaction size, and you can calculate the percentage of winning versus losing trades. If you write down the sectors, you can see what sectors you have a hang of and where you might need to learn more. And if you compare your exit price with your target price and your stop loss level, you will have an idea of how close you stuck to the original plan.
Trading tip 3. You have to be in it to win it too.
Earlier, we discussed that you actually have to trade to make money. In this risk section, let me expand with a quote from legendary trader Larry Hite. I have 2 basic rules about winning in trading, as well as in life. If you don't bet, you can't win. If you lose all your chips, you can't bet. Basically, he is saying that you can't be a trader if you don't trade. But also, and this is relevant here, you won't be a trader for very long if you lose too much money. So you need to develop a trading style where you are able to put on the trades you want, but without ever losing too much of your capital when you are wrong. As they say, the market can remain irrational longer than you can remain solvent. Funny things happen in trading, and sometimes when you start losing money, you just have to give up for a while and step aside until you're back in tune with the market.
Trading tip 4. Size correctly.
To follow up on the previous tip, this is exactly why it is so important to size your trades correctly. If you trade a volatile stock, you should take a smaller position. And if you trade a position for the longer term, you may also want to take a smaller position. The reason to take a smaller position for volatile stocks is because the more a stock moves, the sooner you might lose a lot of money. The reason to take a smaller position, the longer your time frame might be harder to understand. Basically, the longer the time frame, the higher the chance a position will move against you at some point in that time frame, and the higher the chance you'll get stopped out. You want to make sure that if you're right, you make money. So you don't want to size the position so big that you get stopped out in a good idea just because it moves in the wrong direction first. Of course, if you feel strongly about an idea, you should take a larger position or put a wider stop on it. But stick to the risk management rules we discussed in Series 1 of 5-Step Trading. We would very much like to recommend the book Market Wizards, which is full of interviews with some of the best traders of all time. One of the book's recurring themes is that most of these famous traders did have significant losses at some point in their careers because they had too large a bet on. However, each one of them learnt that sizing correctly is the key to staying in the game long term.
Trading tip 5. It's all about supply and demand.
This tip is an extension of the trading mistake that involves holding consensus positions, which basically says that at the end of the day, it is all about supply and demand. It does not matter how good the stock you own is, if everybody else owns it, there is nobody left to buy. The direction of pain will be down in that case, because when everybody owns this stock, the next trade will not be a buy, but a sell. As the first investor or trader starts selling, the price moves down, and the other stock owners will now all start losing money and may start selling as well. Very quickly, a self-fulfilling spiral can develop, and your great stock will drop quickly. So be careful about owning a stock that everybody else owns. The opposite of the previous example can also be true. If a quoted company is no longer a viable entity, it could be very profitable to be short that stock, as it is going to go to zero. However, when the negative news flow dries up for a while, there is an explosive situation in the making. This is because when the first trader takes profits, it might well lead to the next guy doing the same, and then the next, leading to a very large rally called a short squeeze. And even though the company is as bad as ever, the direction of pain for the stock is to go up with all the shorts losing money. So be very careful of getting involved in a stock with a very large short base, as these stocks can easily double in a matter of days, leading to substantial losses. For more information on the current size of the short positions in the market for a certain stock, just type the stock name and the words short interest into your internet search engine and you'll find it very easily.
Trading tip 6. Do not have a position over earnings.
A very successful hedge fund manager friend of mine always sells his positions ahead of earnings. He happens to be a shorter term trader, but I think that for anyone who holds their positions for a couple of months only, it makes sense to have no position over earnings. Price action is driven by fear and greed, and most people tend to have the same opinion about the stock at the same time, and thus play the same direction in that stock. The result is a significant amount of volatility on earnings day, with exacerbated price moves due to everybody being positioned the same way. Therefore, it is normally best practice to get rid of your position before the earnings date and take the position again when the earnings are out of the way. That is, if you still want to.
Trading tip 7. Running losers kills.
I've said it many times before, but running losing positions remains the biggest risk to anyone's portfolio. Most people make this mistake, and it can lead to a portfolio of winning trades being drowned by one or two big losers, and even develop further into a portfolio full of losing trades with very few winners at all. This situation is very demoralizing to look at and will take away so much of your mental energy that it will make it much harder for you to come up with new original trading ideas. So cut your losers quickly. Because running losers kills, you need to always have a stop loss when you trade, at least if you want to keep trading in the long term. As stocks are volatile, they move up and down, and sometimes for inexplicable reasons. So it's very easy to tweak that stop loss by just a few percent to give yourself a better chance to make some money. However, I strongly advise you not to do that, because in the long run, on average, it will be better to stick to your original stop loss level.
Trading tip 8. Be careful of the first profit warning in a well-liked stock. They often come in threes.
As we mentioned earlier, company management tends to be optimistic about the future of their company. There are many reasons for that. The shareholders like to hire somebody positive who can motivate the employees. And having a CEO who thinks that the world is ending is not good for business. Management talking positively about the future tends to be good for the share price. But when business is deteriorating, management will normally try to wait just a little bit longer before they tell the market, just in case it recovers. However, sometimes business goes so badly that management has to issue a profit warning. The stock will then normally drop significantly. The tip here is that you should stay away from stocks that have just had a profit warning, because often there is another one not far behind. Despite the first warning, management is probably still in denial and will not have yet addressed the underlying issues required to make the company successful again. Alternatively, it may be there is nothing they can do anyway, as the environment has structurally changed because of a new competitor or a new competing product or a technological innovation. The company might then struggle on without ever being able to fully recover. As a result, there is often another profit warning not far behind. Of course, this is not true for all companies in all situations. But as a general rule, we would rather have you stay on the safe side.
Trading tip 9. Expect Armageddon, but don't bet on it.
In my last trading tip for now, I would like to tell you that you should always assume the worst case scenario and build your portfolio in such a way that when bad things do happen in the world, you don't get completely wiped out and the majority of your capital is preserved. This tip, however, also says that at the end of the day, you don't want to spend all your day betting on it, You are much better off finding good investment ideas through 5-step trading than betting on and waiting for the world to end. So this is already the end of the Trading Tips module. I hope you enjoyed it, and more importantly, that it will help you conquer the markets. Happy trading!